Hello guys, what's good? It's your boy Side Trades, and I'm here with another video. I'm going to teach you guys how to trade forex, right? So I'm going to start with the basics, some of the basic terms we use in forex, so that you can start trading for yourself. Okay, so I'm going to start with the term forex trading. Now, what is forex trading? Forex simply stands for the FOR stands for foreign, right? And the EX is exchange, so foreign exchange. What that means is that we are comparing two things. We are trading two assets. So it's always one asset against the other. Like the euro against the dollar. So either as euro USD, right? And then gold against the USD. So gold against the USD. But we call that gold, right? But when you say gold, it's gold against the USD. We also have Bitcoin against the USD. We also have USD against the Ghana cedis and so on and so forth. So it's always one asset against the other. Now, what do you do in forex trading? How do you make money? You simply make money by predicting whether an asset price is going to go high or low, or whether an asset price is going to go up or low. So right now, gold is gold against the US dollar, right? So right now the price of gold is here, right? If I predict that gold is going to drop lower, right? And then so let's say now gold is at 4,501, right? So if I predict that gold is going to drop to 4,488, right? And then gold drops to 4,488, I'm going to make money. But then if it moves up from the 4,501, I'll be making loss until I um, give a command to stop out or to get out of the trade. Understand? So we you simply make money by predicting whether an asset price is going to go up or low. You understand? It's going to go up or down. So if you predict that it's going to go up and it goes up, you make money. If you predict that it's going to go lower and it goes low, you make money. That's how it works. And if there are two assets, then there has to be a buyer and a seller. So what you basically do is you either buy or sell an asset, right? So when you say I'm buying, for instance, you call it longing, or I'm longing. You can say I'm buying or I'm longing, which means up. Understand? So I'm longing up. When you talk about sales, I'm shorting, which is down. So I'm predicting the price will go down. When you say I'm buying, means I'm longing. I'm predicting that price is going to go up. Understand? That's how it works. And then the second term you need to know is margin. What is margin? Margin is your own money at risk. Right? So this is what you deposit to be able to trade. Right? That's the money that you are willing to trade with. Your whole capital. That's your margin. Understand? And then the minimum deposit for trading is like $5 for my broker. It's $5. Don't worry if you're not a broker, guys. I'll I'll talk about that soon. We also have a leverage. A leverage, right? What is a leverage? A leverage is like a hypothetical loan or like a multiplier. So what that does is it allows you to trade with small capital, right? And it can be up to 20,000, so like times 20,000. See, and the reason why we leverage is that the price of gold is around 4,500, 4,500, right? So you can't possibly trade it $5, even though $5 is the minimum deposit right there, right? But you cannot trade it $5 because gold is at 4,000. So it's basically impossible to trade $5. So what your broker is going to do is that it's going to give you a loan, a hypothetical loan, right? Or a multiplier. So if you have a leverage of times 20,000 like this, right? It means that it's your $5 times 20,000, and now you have like 100,000, right? you have like 100,000 hypothetical trade, right? So like you have the 100,000 in your account. It's so that you can trade it, right? You don't actually have the 100,000, but then they will give you a critical 20,000, right? And then it will multiply your five, your multiplier. So five times the 2,000, 100,000. So now you can assume that you have 100,000. You can take trades on gold, which is 4,000. You understand? Yeah, so that's how it works. If you take a trade on gold, which is 4,000, you definitely need a leverage. And your broker is going to do that for you, right? You need some multiplier. Alright, so we're going to talk about the next part of trading, which is the take profits, pips, and then loss size. Now, take profits or stop loss. When you say take profits, it's a command, right? It's a command in your program. That's when price gets here, I want to take my money. I'm okay with my profits. Right, so I've made enough when I want to take it. I want to keep that. So get me out of the trade. Take profit means give me my profits or take my profits from me. Just give it to me in my accounts. Right. And then stop loss is also an unfavorable price for your prediction, right? So if you believe the price should uh, go up and then price starts going down, right? So okay, it goes down to this level, to this price, I want to be out of the trade because it's unfavorable for me, right? So it's like, okay, I've lost enough, give me my money, so get me out of the trade, take me out of the trade, yeah. So that's stop loss. Stop loss basically, um, I don't think I'm fine, it's the loss, so get me out of the trade. And you have to know that you don't just set your take profit and then stop loss levels based on your feelings. It has to be based on strategy, or else you are not trading, you are gambling. Let me show you how the stop loss and take profit looks like. Okay, so let's see, you are predicting that the price is going to go up, right? So here, when you predict that when price is at 4,559, you think the price is going to go up, right? So this green side is the profit, right? This red side is the loss. So when price moves in this, when price moves above 4,559, it's profit. You'll be making profit. You'll be making profit. So this is the top of this, which is 5,580, will be our take profits. Okay. So you can adjust it to any way you want it to be. So you don't take your profit from here, you take your profit from here, you take your profit from here. And you just have to know that when price is moving in this green area, it's profits. When it's moving in this red area, it's losses. You are losing your money. Right? So this will be your take profits. This here, this will be your SL, your stop loss, right? And the midline, right, between the green and the red is your entry. Entry where the green and the red meet. It's your entry. That's where you started your prediction, right? Now okay, price going to go up. The same thing for sales. If you are predicting the price going to go down, same thing. This blue area is um, profits, right? It's your profits area or profit zone. And this area is your the red area is your loss zone, right? So if price gets to the top of this red area or to the tip of this red area, you will be stopped out, which means that you would get out of the trade. You understand? And if it gets to this the bottom of this blue area, then it's your that's the take profit. So you would get out of the trade in profits. But if it hits this red tip of the red area first, you will be taken out of the trade with a loss. But if this blue in the tip of this blue area first, you take out the trade with profits. Yeah. So that's how stop loss and take profits work. Now what are pips? Pips are like basically the measurement of price. You know. So just like you have centimeters and meters for length and stuff. Pips is like the measurement of price. So price moves in pips. You understand? For instance, these are edge. These are edge, right? 4,061.547, right? And now these are our loss, our stop loss. You want to know the pips amount or the number of pips that if you have like 5 centimeters, 4 centimeters, and all that. Just check the side. When 1,000 is, that's your stop loss. Pips. That's the pips. So as I adjust the moves, understand? So I adjust the moves. So this 0.1 pip, 18 pips. What? Just check here. So as price is moving, 278 pips, 216 pips, right? So it's just like a graph, right? So horizontal side is x-axis and the vertical side is the y-axis. You understand? So instead of centimeters, having like centimeters or meters here, you have pips. You understand? So every price moves in pips. And then you also have lot size. Now lot size allows you to control your capital, taking into consideration your stop loss. So what that means is that your stop loss, which is the red area or the red region, and we have how many pips? 409 pips, right? You can see from here, it's 409 pips, which means price would have to move 409 pips. See, you'll be stopped out in loss. Right? But to control this, like to control your capital, you need a lot size, right? And the lot size starts from normal lot size starts from 0.01. That's what most brokers use, depending on the account you install it, right? You have 0.01. So 0.01 multiply the 0.01 times the 409, then you multiply by 10. 10 is like a constant because the pip value is $10 per pip. You understand? So for Express, so USD, GB, so on and so forth, right? So 409 times 0.01 is going to be like 4.09, 5 times 10, that will be $40.9, right? Which means you'll be risking, if you use 0.01 lots on this trade, you're risking $40.9. $40.9 will come from your margin. So it means you need, if you want to take a trade like this, you need more than $5. You need like say $50 or $60 to take a trade like this. Understand? So your lot size helps you control your money or capital, your capital at risk basically, right? But it also depends on your stop loss, the pip value of your stop loss. You understand? So to find your capital at risk, you just need to multiply your stop loss, the pip value for your stop loss by the lot size you want to use, and then the lot size you want to use, and then the constant, which is times 10 for Express, right? You can search online for how to do that code, but you don't really need to do all of those calculations, right? You can do all of them on MT5, which I'll talk about in the coming videos, right? Alright, so you guys will be talking about broker. So finally I'm going to talk about what a broker is, right? So a broker is like a third party, right, between you and the market. that allows you to interact in the market. You as a individual trader or what we call a retail trader, you cannot like interact with the market before you have to go to Wall Street when you access the market, right? But now you can do that electronically with brokers. So the brokers are like your Wall Street, you understand? So what brokers mean that when you give commands, like when you issue commands, buy and sell commands, the brokers have to execute them on the market, right? So you have to deposit with them, deposit into the broker's account, right? Deposit into your broker's account, and then you take your trades. When you make profits, you withdraw from your broker's account. Right? That's how it works. So they are the ones that would be executing trades on your behalf. And all that. Yeah. So that will be the end of today's video. And just to let you guys know that I'm going to start live trade on my Discord every day in the week, right? From 7 a.m. to 7:30 a.m. GMT. And I'm going to start from June. I start from June. Would do that throughout the whole year, God willing. So make sure you join the Discord channel. And also, I'm going to leave a link for my broker. The currently the best broker. They have good spread. We'll talk about spread in my next video, right? They have good spread, and then they're also doing a promotion where they give 100% deposit bonus. That is, if you deposit $10, you're going to get $220 included. Right, and I think that is very good for beginners. So make sure you use the focus link in the description for the 100% deposit bonus. See you in the next video. Bye.